Right. Good day, everyone, depending on your location, morning, afternoon, and evening. And welcome to the Business Intelligence Masterclass. And today we'll be looking at balance sheet, which we started it a few series ago. So we'll conclude on this area by God's grace today. We've touched all this, and we came to this point looking at liability, asset liability, and capital, how they all flow. I think we've explained all this to an extent. We've gotten to this point, but all I want us to look at, remember, is a master class, so I may not go details, but what is important to us is how this formula, the last class I took time to explain this formula very, 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 very well. And that the same thing will continue here at a higher level. Asset liability. If you look at all the assets minus liability, what the company is owing, and the remaining one is what after minus, and you have 918.7. That's for this year, for the year in view. Then after that, for the 2 years, the same thing. So by the end of the day, the same amount is what the shareholder for the remaining 918.7. So tell you that all your assets and your liability, the remaining shareholders fund. So that's how companies are run. Just to prove this equation. Do you understand that your assets is equal to your liability plus your capital? So it's as good as that. I understand this equation from this point as well. When is as you understand it. So I explain all this. If you don't understand, please go back to the previous class. Is in our YouTube. Yeah, just go there. You will see it. So let's take up on this note, and so I can run. I want us to conclude on this. We can move to other areas by next week. So understanding the notes. So the balance sheet is a valuable indicator of a business health, and investors must understand how to analyze it. It can be read in two ways at a glance, as on the previous page. Now, where general information is summarized, or in depth with more retained detailed information about each element. Now, following the summary, the detailed section of the balance sheet explains the business specific financial workings through several notes. It shows exactly where money has been gained or lost in numbers, and it often includes a written commentary about potential developments that may affect the company, such as court cases, staffing, etc. So available resources. So you need to just look into these areas. Then notes continues. Investors may want to know more about the figures in the summary section. So additional notes and tables giving detailed background of the numbers. I told us, please go and get what they call it again. Go and get annual reports. Yes, that just type online any of the companies you have in mind. Type it online, ask for the annual report, and you download it and study more about this. All right. So these are samples from assets to liability. Then moving down to the remaining amount of money. So please just study this on your own. Yeah, following that formula. Study all this. All right, cash flow statement. Remember, I said us we're going to go into cash flow, and let me make it a very quick one. Cash flow statement shows the movement of cash during the last accounting period. It's important because it reveals a company's liquidity. Yes, whether it has money coming in than going out. Very, very simple. For every company to be liquid enough, to be on the safe, have money to run the organization, money coming in must be more than money going out. It's as simple as that. Yes, your income must be more than your expenditure. But that's in cash flow, your cash coming in must be more than cash going out. However, if it's not, If it's not, there will be a time the company will run into debt. Not that that the company doesn't have money. They have serious money, but they don't have cash to pay their current liabilities, like salary. You can see a company that when we look at the balance sheet, the company is so rich on the balance sheet, very, very rich, extremely rich. But once the balance sheet, the cash flow is not there, once the money is not there, the company cannot pay. They can't spend money. They can't do activities they're meant to do. They can't settle debts. They can't settle current debts and the rest of them. So that becomes a challenge. So please, I'm begging you, don't ever get to that point where you're not liquid enough to settle, small or current debt. Please, that's what balance sheet is all about. Now, the statement of cash flow, which is balance sheet, to state its official title, answers the key questions of whether a business is making enough money to sustain itself and provide surplus capital to grow the future. Yes, pay any debt, give out dividends. If it's not, there's always a challenge. Let me give you an example. We sell matches. We produce matches and sell matches. Matches, yes. We produce and sell. And we did production for the past 6 months. The entire warehouse is filled up. We even have to borrow warehouses of other companies that are not using for us to store our matches. And we've not been able to sell. On the 7th month, we don't have enough money to pay salary. We paid half salary. On the 8th month, we didn't pay at all. On the 9th month, we paid another half salary. On the 10th month, we didn't pay at all. Do you think that the staff will still remain? Will the staff still remain in the factory working? Please, it's a question I want us to look into.
No.
They will leave.
Some will leave.
Now, is the company making profit or loss at this point?
They're not making any profits.
Okay. Are they making loss?
Let's say loss because the product is still there, unsold.
Okay. The product is unsold. They are not making loss. Do you know why? When you look at the balance sheet, they have powerful assets. Because the product is an asset. They have assets. In balance sheet, they are healthy, but they don't have cash. Did you see the difference? Balance sheet wise, they are very, very healthy.
Yes.
You understand it? Yes. So if you are to evaluate the company, the value of the company will be so high. But in reality, they are not liquid enough. So they will start losing their staff. And that will become their first headache. So both profit and loss, balance sheet, and cash flow are very, very important. That you have money and you're stocking and doing everything. It doesn't guarantee that business is healthy. You see these three areas. The three of them must be well managed. If you focus only on profit, you can be even making the sales. You can be making the sales and making the sales. Your profit and loss account is doing well, so well. But the people have not paid you. You sold on credit. You're on your own. You didn't plan your credit life cycle very well. You are on your own. You need cash to pay. There's no cash to pay. You're making a very grave mistake. So cash is the blood, is the lifeblood of every business. You must be liquid enough to carry out current expenditures. Debts. If you're not liquid enough, then you're not in business. Market. It's not about profit on the paper. It's not about asset on the paper. You must be liquid enough to pay off your debts and do your dividends. Market. Please. And if you're liquid enough, it gives you room to buy off assets from other companies very, very fast and at cheaper rates. Very, very key. So do a study on this. I won't bother us on this. This is about cash flow, but at a higher level. I won't bother us. It's a master class. So how it works. The cash flow statement is often more useful for investors. Yes. Assessing a business health than other key statements because it shows how the core activities are performing. It's as simple as that. And I've explained that to us. The profit and loss statement, for example, obscure this by adding the non-cash factors such as depreciation. Similarly, the balance sheet is more concerned with assets than liability and than liquidity. It's only cash flow that talks about liquidity. And without liquidity, you don't have a company. Yes, mark it from me. Without liquidity, you don't have a company. Let me bring it back home, Seth. You are a father, a mother, 5 children, and you have land. You bought land, like you have like 100 different, plots of land, different areas. Yes, and you have 5 children. Your son, out of the 5, 4 in university, 1 is in secondary school, and they all came back at the same time, and they needed money to go back. Probably when you calculate all the money you need to spend on all of them, let's say in Nigeria currency is about 3 million. And each of those your land, the list of your land is 10 million. The list is 10 million times 100. That's the list of it. Some are even 100 million plus. But you don't have anybody to buy the land. And nobody have agreed to borrow you money in place of the land. And your sons and your daughters must go to school by, today is a Friday morning. They must go back to school by Monday morning. And if they don't get back to school, the other one is doing medicine. He will miss his exams. And once he misses the exams, he will repeat that class again. And so a number of challenges. At that point in time, I'll ask this question: are you a big boy? Can you beat your chest and say you're a big boy? Are you happy? Can you beat your chest and say, I'm a happy man, I'm very wealthy, this and that? That's another question. I need us to discuss that in 1 second. Can we throw light on this? I just give us a scenario.
A big man with small ass.
Beautiful. That's simple truth. You're answering big man, but it can't solve problem. That's just it. Another person, please. One more person, throw light on this.
You're not a big man because you don't have the cash.
It's as simple as that. I don't have what it takes. In assets, you're so big. That's simple. Go ahead, Andy.
It's a potential big man. The time can also change anytime.
Do you understand? So this is exactly what happens in organizations. Assets, they are very rich. But in reality, when it comes to liquidity, they are not. And that will mess up the whole thing. Please, you need to balance this 3. Please. Yeah, profit and loss is good. Profit is very good. Asset is very good. But liquidity is the king. Very, very important. 3 types of cash flow. Cash flow refers to actual money as well as a cash equivalent. Yes, including cash in the bank lines of credit, and the short-term and short-terms high liquidity investment for which there is little risk of its change in value. Cash does not include interest, yes, depreciation or bad debt. You've understood this. So even if you don't have cash, direct cash stuck in your house, have money in your bank account. If there's no money in the bank, at least have credit line. Be credit worthy that you can call your bank now saying, I need 3 million now. And before you finish stocking, there's credit of 3 million in your account. Very, very important. Make sure that your liquidity level will always be there. At least enough to take care of your basic needs, not wants. Basic needs, not wants. Please. 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 Short-term cash. Very, very important. Please. Cash flow from operating activities. The bulk of cash flow usually comes from operations and is worked out with a formula. The change in working capital, that's current asset minus current liability, can be a negative figure. What does it mean that the cash is not doing well? Yes, you can have so much cash, access to cash, but the company can also not be making profit. That's a different thing altogether. But what's important to us now is your liquidity level. So there's the formula. Revenue minus cost of sales. When we do finance, yes, for those of us in class, we're going to do this in a more simple way, so you understand how all these things came. I won't bother you here. Cash flow from operating activities. In this example, a juice company sells $100 worth of orange juice after spending $20 on oranges. It pays 25% of its 800 pounds earning in tax. Now, its juice machine incurred a repair expenses of $20 over the period, which is another cash outlay. Now, there is no change with working capital, short-term assets to cover short-term debt. Just look at this. 100. Out of 100, 20 is gone. Another one is another 20 is gone. That is 40 gone. What is 25% of $80, please? Can someone help me? What is 25% of $80?
It's $20.
$20. So have 20, 60 is gone already. How many remaining? How many remaining?
That's $40.
$40 left. Do you understand the maths? So that is cash still remaining. So in reality, he has enough to tackle other expenses. Do you see it? That's cash flow for you. Assuming he sold on credit. Assuming he sold on credit. Can he still pay tax? Can he still pay tax? Let's discuss it. Can he still pay tax?
If only you can pay tax on credit. You cannot.
Beautiful. So you have to borrow money to pay tax. Can he repair the machine? He cannot repair the machine. Assuming they were like two other persons that helped him to make the sales. Can he sort them out? The answer is no. Because he sold on credit. He didn't check his credit life cycle. So that's the essence of liquidity. Liquidity is very, very important. Extremely important. Cash flow from investing activities. buying and selling assets or investment is in this category. This figure is usually a cash flow, a cash outflow, negative figures due to buying more than selling, but it can be positive if there are what significant sales. Yes, that's under investment. That land I mentioned is one of them. I know people that they keep buying and buying and buying and buying and buying things, investing. Please, as beautiful as investment is, don't get to the point where you keep begging for cash. We know you're a big boy, but please remain cash for expenses. Cash flow from financial activities. This includes buying and selling stock, paying out debt or dividend. Money made from selling something is called cash inflow. Money lost through paying out is cash outflow. Total cash flow. Adding all the three cash flows gives the total. Separating out the three cash flow, this cash types shows decision makers the health of cash activities as opposed to financing and the investing, which bears little relation to the day-to-day operation. All right. Environmental accounting. This is very, very important to me. I know it's not what we are used to. Environmental accounting is not what we are used to. It's something very, very new. Something very, very new. But is what I will look into it by next week. We'll look into it by next week, environmental accounting. And I want us to it's very simple. There's not much about it. Look into it by next week. So can we discuss on cash flow, please? I want to know your experience, cash flow. Has cash really done anything to you in the past? I mean, you're a big boy, but because you're not liquid enough, you miss something or negatively or positively, or if you were liquid enough, you're able to gain advantage and all that. Can we discuss that? Can we discuss that? From the previous classes, all we've done down to this current one. What are your take homes? Can we discuss all that? Please go ahead. It's a master class. I expect you to have contributions. What's your experience with cash? What's your experience have you had in the past? Let's take it from there. If there's none, I will run the remaining classes. Yeah. Yeah. Please, what's your take home? Let me use that word. What's your take home, please? If someone asks you, you were awake this morning, what have you learned for being awake for almost 40 minutes now?
Okay, thank you so much, sir.
You're welcome.
Thank you for this class.
Thank you, sir.
I came in a little bit late. I'm sorry about, but I learned that cash is very important. Cash is the life of every business, the blood life of every business. So it's very important to know and understand your cash flow and not to spend everything, but remain some for the future investment or whatever you want to do.
Yes.
Very much.
Yes. Beautiful. Always be liquid or near liquid. Always be liquid or near liquid. You may, even if you don't have the cash, you should have capacity that if there's need for cash, you can call your bank and they will give you cash immediately. You have the goodwill that you don't have cash, but you can place a call and money will come immediately. Very, very important. Go ahead, sir.
Good morning, all.
Good morning, sir.
I learned so much this morning, but where I want to talk about in this cash flow is for a company to have cash, because one thing about like put a do for in business, when cash is flowing, they tend to invest, they tend to buy. If it's a production company, they tend to buy raw materials and trying to put the cash in different areas whereby they're expecting maybe when they start sales. So for company to have cash, to have liquidity, is they have to also look at their sales, when how their sales goes, and also balancing with the investment or the outflow of the cash, so that they won't they won't be stranded in terms of not having enough cash. Why I say so is like a real estate company doesn't always have cash flow, because any money that comes in, they try to put it in one property or the other, expecting clients to come anytime to buy. And sometimes you'll discover at the end of the month or sometime, they won't have cash flow even to pay salaries and all that, and to make some immediate cash. So cash, the sales and the investment aspect is very key in a company, whereby, because these days it's not even easy for some banks to call them, they do overdraft for you. But the way I see it is, when the cash flow comes in, the company should look at their expenses, and then plan ahead.
Plan ahead.
Plan ahead. Don't spend all or invest all. One of the things, like my company, one of the things we try to do is to make sure we don't owe salary beyond a particular time. We don't owe salary beyond the first. We don't owe salary at the end of the month. You still owe salary to enter the next month for it's not done. Like the example we gave for a company that produce matches.
Yeah.
They have enough products, but they don't have cash to pay their staff. They don't have a good plan for the future.
Yeah.
So planning ahead is very important in this cash flow. Knowing how your cash flows, and then knowing how to invest it. It will help to have a liquidity for the company.
Beautiful. I really appreciate. iPhone said, in as much as investment is good, keep cash for expenses. Yes. Mr. Andy said, I learned that liquidity is king. Good. Christian said, cash flow is not just very important to companies, but also individuals. Beautiful. Companies, families, just mention them. These are wonderful contributions. I'm really impressed this morning. Wow. Can we have more of these contributions? Can we have more? Thank you, Sir Iwundu. Thank you so much. Thank you so much. Dr. Iwundu is an alumni of Learn to Do Business School, and he's doing so much well, and other alumni also that are here. Thank you so much, everyone. Thank you. Can we have more? For those of us who are not part of the school, please enroll. There are more to learn. All right. Go ahead. Next person, at least one more person, please. One more person. Collins, you've been on this call. What's your take? Mr. Collins.
Yes, sir. Good morning, sir.
Good morning.
I'm fine. How are you doing? I'm just enjoying the whole thing. I've been out for a while. So
Yes.
I said my one leg stand today because I never come since.
Yes,
but I'm enjoying the whole thing. At least on a personal note, just like our companies operate, it's good that we don't also spend all we earn. We that are working under people, we that are earning, it is illegal to eat everything you have because emergency can come up in the family within the month, within the week. And if you don't save, if you don't remove something and keep somewhere, when those emergency crops up, you cannot go back to anywhere. So even as we balance our company sheets, we also balance our family sheets. Let me stay here for now. Thank you.
Beautiful. On this note, we'll be saying thank you to everyone. Say, even as we balance our company sheet, we also balance our family sheets. So that's another word again. We'll go home with today. Wow, I love that. Thank you so much. Okay. Wow. Okay. Yes. Okay. So Emmanuel. So I should look at the formula. Okay, again, it's expected to be 80 instead of 40. Yes, we didn't put it into consideration. Yes, this is cash flow from operating activities. Where all we did was the 100 was the total cash inflow. Then say 20 was spent on oranges. Do you understand? Because you must spend that 20. So the remaining money here, which is the 80, are what came in. They counted $80 first. It's from that $80, that's the total cash that came in straight before they start paying tax, paying salaries, and other repairs. Do you understand? That was a total inflow of cash first before they start spending on repairs and other things. That's why you're seeing the 80 there. Yes, it's not that. Yeah, we know by the time you finish spending, you now have 40 left. Yes, that's why I went ahead to do that mathematics. Yes, so that 40 is more of like a gross profit. Yes, more of a gross profit because there may be other dividends paid and the rest of it. So it's deliberate. Yeah, I hope you understand, sir. Yeah, money is the lifeblood in our system. Good. Thank you so much, everyone. By next week, God's grace, we'll go into environmental accounting, and after that, after environmental accounting, we'll move to one more thing. I think, depreciation and all that, so we can conclude on this and move into other things. So see you next week as you remain fruitful in whatever you're doing. Thank you. God bless you.
Thank you, sir.
Thank you.
Thank you so much, Doctor. God bless you, sir.
Thank you.